Hi, my name is Victor Fung, and this is my presentation on Peachtree Case A. Question 1 asks, why are T-bond return rates the same in every economy? As you can see on this table, no matter what the state of economy is in, whether it's a recession or a boom, the T-bond's estimated total return stays the same at 8%. This is due to the T-bonds being a government security. The only reason the return would change would be if the Federal Reserve changes it. This leads to the T-bond being a risk-free investment. So what is the expected rate of return for each alternative security? The expected rate of return is found by multiplying the security's probability and their estimated total return together for each state of economy and taking the sum of the calculated amount. This would lead to an expected rate of return of 8% for T-bond, 13.5% for TICO, 0.8% for Gold Hill, and 15% for S&P 500. Based solely on expected rate of returns, the S&P 500 fund appears to be the best investment because of its highest mean return rate at 15%. Question 3 asks, what are the calculated standard deviations and coefficient of variations of each alternative? T-bond has a 0% standard deviation, TICO 11.72%, Gold Hill 9.09%, and 16.43% for the S&P 500. T-bond has a coefficient of variation of 0%, TICO 86.78%, Gold Hill 103.25%, and 109.54% for S&P 500. So what does the standard deviation and the coefficient of variations do? It measures the volatility of the security. Which is the better measure of the two? The coefficient of variations is. This is because it takes the standard deviation a step further. The formula for this is you take the standard deviation and divide it by the mean. By doing this, it is better to have a lower coefficient of variation than to have a higher one. Question 4 had to do with what would happen if a portfolio was created with $10,000 in Gold Hill and $10,000 in TICO. This portfolio would have an overall expected rate of return of 11.15%, a standard deviation of 2.89%, and a coefficient of variation of 25.92%. As you can see when comparing the numbers of the portfolio's overall standard deviation and coefficient of variation to their individual stock percentages, the risk has been lowered and diversified. If the portfolio contains 75% Gold Hill or 75% TICO, then the average return for Gold Hill would be 9.98% and TICO would be 12.33%. The standard deviation would be 4.48% for Gold Hill and 6.89% for TICO. Doing these 75-25 portfolios would both be riskier than just doing Gold Hill and TICO evenly at $10,000 apiece. Just like the previous question, question 5 now asks what would happen if a portfolio was created with $10,000 in TICO and $10,000 in S&P 500. In this situation, the standard deviation is a lot higher at 14.06%. This makes this scenario a lot riskier than the Gold Hill and TICO portfolio that only had a standard deviation of 2.89%. Question 6 asked what would happen if more and more random stocks were added into the portfolio. This would cause risk to diversify. Ultimately, risk would decrease along with the amount of return. The three different risks are total risk, diversifiable risk, and market risk. Total risk is every factor that could possibly affect an investing decision. Diversifiable risk has to do with the company in question itself. An example of this would be what the news is saying about that company. Market risk has to do with the fluctuation of the market on an everyday basis. So knowing about risk and diversification, Having a single stock portfolio is not a good thing. On this slide here is a chart that compares TICO, Gold Hill, and T-Bond using the S&P 500 as the market. The lines with colors are called trend lines, and the black lines are the linear regression lines. The equations that are shown are the slopes of each alternative. The difference between each alternative's trend line to their linear regression line shows how attainable or unattainable the returns really are. As you can see for Gold Hill, they have a huge gap between their trend and linear regression lines. This means that the fluctuation between the calculated return and the actual return it would receive could be very different. This chart shows where the TICO's actual required rate of return is compared to the CAPM required rate of return with a beta of 0.6 security market line. As you can see, TICO with a 13.5% required rate of return is above the market line that has a 12.2% required rate of return. With that said, since TICO's actual required rate of return is higher than that of the market lines, then TICO stock is undervalued, and it should be purchased. Question 9 has to do with what would happen to TICO's required rate of return in different situations using the CAPM equation. If inflation was to increase an extra 3%, then the required rate of return would be 13.4%. If the market risk premium increased from 7% to 8%, then the required rate of return would be 12.8%. If beta increased from 0.6 to 1, then the required rate of return would be 15%. So what is the efficient markets of hypothesis? This is a theory that states that you cannot beat the market. There is no such thing as an undervalued security. There is no inflation of prices, and if you want a return, then you must take risks. This impacts companies on corporate finance decisions and hiring. The impact on corporate finance decisions is that the firm has to focus only on high-risk, high-return equity. Hiring would be affected because you would only want to hire analysts who have a risk mentality opposed to those who search for undervalued securities. Real assets such as plant and equipment would not be affected by this theory, though. Question 10 asks, what would happen if TICO's long-term debt ratio decreases and is projected to keep on decreasing? In this case, either their long-term debt is decreasing or their total assets are increasing. Basically, risk would decrease, and since risk decrease, then the beta decreases, and the required rate of return on equity increase. This now concludes my presentation on Peachtree Case A. Thank you, and have a wonderful day.